Well, we thank you for coming today in the midst of, I know, a very heated debate. We're glad to come together around an issue that we know has been troubling our country for 5 years. It's been 5 years since the meltdown and the involvement, if you will, by the federal government in Fannie and Freddie. And this group of 7 senators plus Jerry Moran, who couldn't be with us, have all agreed to come together and co-sponsor legislation that we've all been working on for some time. I'm really excited that we have 8 members of the Banking Committee, 4 on each side, 8 active members. This is a very complex issue, and I really appreciate all the time that all of us have put into it and our staffs. It lessens the footprint of the federal government and housing. It winds down Fannie and Freddie, but at the same time it keeps the housing finance industry in a liquid state, something that we believe is good for our country. I think you know that the window is closing. Over time, Fannie and Freddie have continued to have more and more profits, and we believe that it's time to act. We have met with chairman and ranking members on the Banking Committee, and they've discussed the fact that they believe they're going to take up FHA reform sometime between now and the August recess. And they've indicated a willingness to take up GSE reform right after that. So I want to congratulate my colleagues, all of which who've contributed heavily to the substance that is in this bill that we're releasing today. Thank them and look forward to working with them. This is just the beginning. We know that there's a committee process and a floor process. We hope this bill sees both, and we look forward to working with all involved to make this bill even better. And with that, I want to turn over to my great partner, Mark Warner. We worked together on Dodd-Frank, on Title II. We actually came to an agreement, as all of us have on this bill, and I want to thank him for being a great partner.
Thank you, Bob.
Thank you.
I want to echo the same to Bob. I think we all know a lot more about the plumbing of the housing finance industry today than we did a year past. It's a complicated issue, but it's one that needs reform. And anytime you've got in this body 8 members of the Banking Committee, equally numbered, Democrat, Republican, willing to put forward a comprehensive solution to the one part of financial reform that's not yet been addressed, then I think this is a step forward. As Bob indicated, I'm happy to get into the details. This preserves the federal guarantee, but makes sure that there's that private sector first dollar loss that will help ensure that these securities have got the kind of underwriting and capital, so we no longer have the circumstance where you've got private sector gains and public sector losses. We also ensure that the social purpose that sometimes was commingled with Fannie and Freddie is kind of separated out. There's still going to be support for low-income housing and support for rental housing, but it'll be separately identified. And we give an appropriate transition period over a 5-year period to kind of wind down the existing entities in Fannie and Freddie as we step up both this new reinsurance model, modeled after the FDIC, FIMIC, as well as the new regulatory structure. So I think we've got a good product. Happy the fact that we've consulted with the administration along the way, as well as all the various stakeholders, and think this is very important. I'm going to turn it over now to Mike Johans and John Tester, who kind of people have come in pairs on this. I know they're going to speak as well to a critical component of this bill, ensuring that those smaller institutions, the community-based banks and the credit unions and others, still have access to this issuance function in a way that both keeps them freedom, flexibility, and appropriate pricing. With that, somebody as well that we've been in, the only thing, I guess, requirement we're going to ask is we not be called a gang here. Although I've been in gangs with Mike in the past, and they've, and I'm not sure on immigration, Bob, whether you're a gang addition or not, but somebody I've had a chance to work with for a lot over the years, and former governor, great senator, former secretary of agriculture, Mike Johans.
Thank you very much. Well, let me start out and say thank you to Senator Corker and Warner. All of us worked on this, but they were the folks that kind of kept pulling us together and tried to keep us focused on trying to get this done. If you think about this, about 4 or 5 years ago, trillions of dollars of personal savings were wiped out in the 2008 housing crisis. And because of the way that Fannie and Freddie were organized, taxpayers were forced to open up their wallets. And that was to the tune of about $188 billion to bail out these entities that were really structurally flawed. Most surprising is that all these years later, really nothing has changed. We've seen recovery in the housing market, especially in some parts of the country, but the basic structure is still there. The status quo has prevailed in our economy. If our economy took another hit, taxpayers would be left to foot the bill again. So it's time to end this failed model. And this bipartisan legislation does exactly that. It builds a firewall around our taxpayers. But it also ensures something that's very important to all of us. It's very important to me. It ensures that making mortgage loans in our small towns with community bankers or credit unions, that they will have equal access to the secondary market. And it makes sure that they are not swallowed up by the mega banks in our country. Senator Tester and I, with the strong support of our colleagues, work very, very hard to make sure that our community lenders would be a part of this legislation and would be able to benefit from this legislation and would not be pushed out. So I thank all of my colleagues for being a part of that effort. In a state like Nebraska, this is enormously important, and I'm very pleased to stand here today to encourage that this legislation go forward and eventually we pass it. With that, I will invite my colleague, Senator Tester, to the podium.
Thank you very much. So if we're not a gang, I guess we're a flock or a bevy or a herd. Look, as everybody's alluded to, we're coming out of the worst financial crisis since the 1930s, and I think the last piece of rebuilding this economy, at least the last major piece, is the housing industry, and that's exactly what this bill is meant to do. Give some certainty, give some liquidity, give some access to the housing market. As Mike Johann said, one of the big concerns in rural America, but I think it's also a concern in urban America, is access, and we've worked hard to make sure that the community banks and the credit unions have access to this marketplace without having to deal with the big banks by setting up a mutual. But the bottom line is that this is going to work for everybody across the board. It's going to work for the industry. It's going to work for the builders, for the realtors, but most important, it's going to work for the consumers. I too want to thank Warner and Corker for their great job. I think if you take a look at the 8 people who are up here off the banking committee that are in support of this, it's a broad-based political views, and I think it speaks to their hard work and their intellect, quite frankly, on this issue that brings everybody together. As chairman and Mike Johans as ranking member of the Securities, Insurance, and Investments Committee, we're going to work hard to get this thing across the finish line. We're going to hopefully encourage the full committee to do a markup in the fall so we can get this bill to the floor. As Bob Corker said, time is of the essence here. We have a window of opportunity, and we do not want to waste that opportunity. So I want to thank you all for being here. It's great to be a part of this group.
You gotta bring Dean up.
That's okay. I need no introduction. You got a broken leg. Sorry.
That's all right, John. Boy, what an honor it is to be here with my colleagues. And John alluded to the fact that we're very diverse in our political backgrounds, but I think we've all come together on an issue that I think is extremely important for America. And if I can say this, just as important for the state of Nevada, I don't think there was any state in the country that was more affected by the housing crisis than the state of Nevada. And you can just look at the numbers today. 50% of the homes in Nevada today are underwater. There are 400,000 homes in Nevada that have received notices of foreclosure. If this issue isn't important to creating jobs and helping the housing industry in Nevada, I don't know what is. We've done a lot of reform here in the last couple of years, and others have spoken on this, but healthcare reform, banking reform, now we're working on immigration reform, and now's the time for housing reform. If there was ever a time, this is now the time to do this. And with 8 members of the banking committee, I really truly believe we can get something done. I believe there's 2 types of legislation when you come to Washington, D.C. Those that help, those that have consequences in the crisis that we've had to deal with over the last 5 years. And the second type of legislation is those that keep this crisis from happening again in the future. And that's what this legislation is all about, to try to keep this crisis from happening again in the future. So I'm pleased to join with my colleagues and spend some time with them. We've got a long road, but I believe this is a good bill, and I'm looking forward to working with my colleagues to make this happen. So with that, I want to introduce my friend from North Dakota, Heidi. It's all yours. Thanks.
Thanks, Steve. It's almost ironic that I would follow someone from Nevada, because our problem in North Dakota is exactly the opposite. We've got a housing crisis because we have a economic boom in our state where we project by 2025 we'll need 33% more units, single-family units in our state. You think about that, and you think about what's the capacity to build that. And let me tell you, financing is a huge part of this, and the issue that the senators who have spoken before about making sure that our small community banks and our credit unions can participate, can do a long-range mortgage, that our citizens have access to it, is absolutely critical. But beyond the substance of this, it is absolutely enlightening and encouraging for me as a freshman member of the banking committee to be involved in this effort, and maybe just give you some insight, because I think that the American public is a little jaded about the work that goes on here. And coming into this and seeing senators, not just staff, but senators roll up their sleeves, understand the issue, go through the complexities of it, negotiate, and actually come to a bipartisan resolution on a major piece of reform is an amazing thing to watch. It tells us that this Congress can work again if we all decide to work together with goals, maybe not knowing what the solution's going to be, maybe not always doing the same thing that we've always done, which is the Fannie-Freddie thing, and looking at this from a completely different perspective, meeting the goals that each side has, but coming to consensus on a package. And I think you see that in the bipartisan nature of the sponsors, but you also see that in the commitments that you're already seeing from the various stakeholders, and from the very smallest to the credit unions and the small community banks to the large mortgage insurers. And so if we can get this done, the signal is clear. We'll give you predictability in the marketplace. We'll help restore the confidence that the American public should have in the American Congress, and we'll get America working again. And so I want to thank Senators Warner and Corker for really restoring my faith that United States senators can sit down in very complex kind of setting with all of these other ideas and come to resolution on a major and significant piece of legislation. Thank you, senators. You guys do a great job.
Well, you've heard a lot already this afternoon, and I'm really pleased to be here because this is a bipartisan effort to really have a transformation in our housing industry. And even the title of the bill, Housing Finance Reform and Taxpayer Protection Act. This is what we're talking about, and that's why this is so important. I'm truly pleased to be a part of it. And as Senator Heidkamp said, this is the Senate at work. Democrats and Republicans sitting down together, negotiating and agreeing and coming forward. This bill provides a crucial starting point for restructuring the mortgage market in a way that ensures secondary market liquidity and allows qualified borrowers to obtain sustainable mortgages. We all know that we've got to move away from the status quo with respect to Fannie Mae and Freddie Mac. Under this legislation, Fannie Mae and Freddie Mac would be wound down over 5 years. Their utility duties and functions would be transferred to a modernized and streamlined agency. All of this would be done with the fiduciary duty to maximize returns to the taxpayer via the Treasury as the GSE's assets are sold off. Under the bill, we also envision a housing finance system that is more responsive to consumers while better protecting the taxpayer from a future crisis. Never again should taxpayers be on the hook for losses sustained in the private sector. And that's why I'm so pleased to be on this bill. The new regulator will have improved underwriting standards to make sure families are offered appropriate mortgages for their financial status and they don't get stuck in mortgages they cannot afford. So I highly commend Senators Corker and Senator Warner for taking the leadership, being active on this issue, and I think we all look forward to hearing from stakeholders, working with our other colleagues to continue improving upon the bill, as well as advancing bipartisan legislation, which is what this group is all about, to really reform the housing finance system. Thanks to both of you and everybody else.
Thank you. Well, as you can see, with Senators Tester, Hagan, Johans, Warner, Heller, and Heitkamp, and Moran in the wings, everybody brought a different perspective, a unique perspective to this legislation, and it's helped it be even better. And I know there are numbers of questions. I do want to take a point of personal privilege. I know most of these members really well. We've served together for a long time, but Heidi is a new member to the committee, and she is, to use an adage back in Tennessee, stronger than battery acid. She is really, I think, added a degree of passion to this that I greatly appreciate, and I hope you take that as a compliment.
No, I do.
Okay, so, but I wish somebody'd say that about me. But in any event, thank you all, and I'm sure you have some questions. We'd be glad to answer them. And if not,
Yeah.
that's even
It's
better.
even better. We just want to take our statements, we'll go with that too.
So you said you talked to the Chairman Johnson and Member Capreco about the bill, and you said there was a willingness to consider this going forward. Has there been any strong indication? Are they on board with the legislation? Have they given any suggestions for what they'd like to see changed if they need that to get their support?
Yeah, I wouldn't want you to read this as they're endorsing the bill. I think they understand that FHA reform and GSE reform need to be linked. You need to understand what's happening in one arena so that in passing legislation you don't end up doing something that sends all the business, if you will, in another direction or in the wrong direction. So as I understand it, it's their goal to commit FHA reform to finish it by the August recess. And it's their goal to take up GSE reform. I'm sure there are going to be other ideas to put forth, and I know that any bill can be improved. We're seeing that happen right now with immigration after months and months of work. So I think what I would read into this is they understand the importance. And I want to say, as Mark highlighted, we have worked closely with the administration on a lot of technical assistance. They've been very helpful to us. Again, that's not an endorsement either. But I think everyone, if you saw one of the most recent committee hearings, I think everyone on the committee, and we actually had a lot of attendance that day, indicated that it was time to deal with GSE reform. We hope we provided a good base to work off of, and we hope that'll lead to a result.
I actually think as well, just echoing what Bob said, is that if you've got a framework here, if you've got the kind of macro issues that there's still going to be more private capital at risk, but still having a government backstop modeled after the FDIC model with a kind of reinsurance fund, it helps FHA reform, because it's hard to do FHA reform in the abstract if you don't know what's going to happen to Fannie and Freddie. So I think this actually hopefully helps the committee process, and we think we've got a lot of momentum behind us. Yeah.
Can you explain how you got to the 10% amount on the first loss, and then you've talked to the House side where Garrett and Hensley are starting is much more conservative than where you are. So how do you see that you could reconcile those differences?
Well, if you look at the crisis that we just went through, Fannie and Freddie have $5 trillion in assets together. If they had just had a 5% buffer, there would have been no taxpayer losses. So as we began to look at what the market could bear, that's the number that we arrived at. I think you also know that there's a DIF fund, FEMIC. I think Kay was going into some of the details on FEMIC, but there's a DIF fund also. So what this creates is a large amount of capital in advance of any kind of government reinsurance. And to me, candidly, I think that could work very well. I know the House is going to move first to try to do something without government involvement in any way. I know there's been that hasn't happened yet. But I think what we've arrived at is something that's an outstanding blend of the two. I mean, look at it. If that would require today at $5 trillion in assets to have $500 billion of private capital in advance of any kind of government reinsurance. So we think we've hit the right mark there, the right balance. We'll get private sector signals with that kind of capital. We've given the FEMIC director the ability to do that through A and B pieces, through credit-linked notes, through something that we call in the bill as a private bond guarantor that has 10% again capital base. So we think we've hit the balance between the two that'll work very, very well for taxpayers. I know I'm long-winded. I'll say one more thing. A lot of people say, well, you know, the federal government is really no good at pricing risk, and let's face it, the federal government is no good at pricing risk, okay? But when you've got a 10% capital buffer in advance, it really causes that pricing of risk to be far less important, because what you have out there is a huge investment by the private sector in advance of any kind of government reinsurance, and that ought to be soothing to taxpayers that people who are taking this risk are looking at the risk that they're investing in advance. I'm sorry to be so long.
And I would just add that, you know, as Bob mentioned, we've given the FEMIC director the ability to put that credit enhancement, you know, credit-linked notes, other sources, private mortgage insurance. There's a series of
Not private mortgage insurance.
but there's a piece of that that can be fitted in there that is a component of how you structure this. So there'll be a variety of structures used in that 10%, and they will be able to help price that in a way that I think will get the market reaction, and that will also ensure better that, you know, there's what a number of us have said in terms of you know, trying to make sure that if the appropriate pricing is made there, the government pricing the back end reinsurance is important, but is less important, because that helps with the extra due diligence on the front end. The other thing we've talked about is that, you know, we got constant reference across the board. If you want to keep a 30-year fixed product, if you want the kind of liquidity, you know, that is somewhat unique to the American market, you need that reinsurance on the back end.
You know, one thing that's worth mentioning, I think Bob referenced this, is, and it's a very valid point, as this legislation was being put together and we were looking at it and trying to figure out the right approach, one thing I kept asking myself is, if this legislation had been in place back when this crisis occurred, what would have been the ramifications? And I think in this case, with that private investment, we would have protected the taxpayer. So I think throughout the debate on this legislation, if we can keep referencing back to that key question, had this been in place, what would the difference have been? This really would have been a significant game changer. That argues for us to go forward with this type of model, this kind of approach.
Yeah.
A follow-up question. So have you kind of done an estimate on how much equity capital needs to be raised to meet that 10%? I mean, are we looking at about an estimate of $500 billion from private
That's, again, if you
investors?
take the size of the market right now and you look at the
Do you think it's-
10%, you know, I think that, you know, that's the kind of range. But again, there's an ability to structure that capital that we've given the FEMIC director some discretion on.
So remember, you'll be winding down Fannie and Freddie, and we drop the loan amounts over a 5-year period, and then they're wound down and out of business over a 5-year period. So you're building up the numbers of transactions that are going through FEMIC over time. So you're starting off not needing any capital, and then it builds up as the number of loans are processed through there. But yes, we believe that there is easily the ability to have 10% capital up front, and to build on what Mark mentioned earlier. So the belt and suspenders to protect taxpayers are that all loans above 80% loan to value have the private mortgage insurance that Mark alluded to, and I know Kay and others have pushed for heavily. You have the actual loan, and then you've got the 10% capital in advance of anything happening, and that means those, not only their capital is at risk, but they have to be taken out of business and insolvent before you ever get down to the DIF fund. So there's a DIF fund at the bottom. So you've got the down payment by the homeowner, you got private mortgage insurance, you've got the 10% private sector capital, which is the most important element. And then you have the diff fund at the bottom,
And the
all
diff
of
fund
which
even
protect
itself
the taxpayer.
has some funds coming into it paid off of the G fees that generate even another layer before you would get to any ultimate taxpayer.
And you have stricter underwriting standards.
You mentioned the dividends coming in from Fannie and Freddie, and how difficult do you think it's gonna be to push this forward when the government and the Congress sees that money coming in, the debt's
Well,
only being pushed
Well,
out?
let me just mention this, and there are those who've made those investments. You know, the great thing about the free enterprise system, there are risk and rewards on making any investment. But the current structure right now has all of those profits swept into the Treasury. You know, the remarkable thing is we're at 188 billion bucks still on the balance sheet that is owed, even though the repayments, the dividends, have accounted for about 133 billion. There are folks who have brought suit on that issue. That will be resolved. And you know, I would mention that the last quarter was an exceptionally high quarter because they kind of remarked part of their book. And I want to make one comment on this, and I say this as somebody who's got Freddie Mac and my in Virginia and Fannie over in the district. You know, we're taking parts of Fannie and Freddie, part the kind of customized platform that Mr. DeMarco is building right now. Those assets will be kind of a utility function. There'll be parts that will be taken into the mutual that will ensure that the community banks and the credit unions take place. There'll be that credit enhancement review police that will go elsewhere as well. I think the people, the technology, and I say this particularly to the people at Fannie and Freddie, you know, they're going to have, because they have done I think particularly the new team have done a good job of bringing these institutions back. You know, there's a lot of value there. Obviously, first and foremost, the taxpayer has to get full recoupment, but those individuals, I think, are going to have a bright future. It's clearly going to have a different name. There will be different components broken into different pieces, but I think those folks, that's an asset for the taxpayer has to recoup, but also an asset long term for the housing finance industry.
Anybody else want to?
Yeah, the only thing I'd say is that,
Can you come
You
to
know-
the microphones, please, Susan?
sure. Fannie Mae and Freddie Mac are on the hook for everything right now. Taxpayers are on the hook for everything right now. And that should be impetus for Congress to act to protect the taxpayer while keeping a 30-year note, while keeping liquidity, while keeping access, which is what this bill does. This is really a win-win deal. When the folks come in and say, well, you know, Fannie Mae and Freddie Mac are making a bunch of money, bottom line is the taxpayer's still on the hook, and we need to fix that. And that's what this bill does.
Anybody else want to say something? I do want to mention a technicality that's important. If we don't resolve this issue soon, we're going to have to come up with a pay for, believe it or not, you know how Congress works, CBO. We're going to actually have a pay for to wind down Fannie and Freddie. So I think that is impetus for us, meaning that if you wanted to end up doing the things that need to be done, if you wait much longer because of all the G fees that are coming into the
If you
Treasury
go
and
into
the Corker,
positive territory, you can offset.
that's
that.
exactly right. So if Congress ever wants to deal with this, we've got to do it fairly soon.
Following up on what Senator Warner just said about all the technology and the people there, why not make your FLIC on the back of Fannie and Freddie as they exist? You know, I understand the political argument that they have to go, but is there a policy argument that says?
Yeah, I think the straight argument is, you know, there are some who simply say recap Fannie and Freddie or re-IPO them. You know, we could get into lots of technical problems in terms of the differential between their trading ranges at this point. But the fact of the matter is, you know, you leave the taxpayers exposed. We're setting up, you know, a brand new system that puts more private capital at risk, that puts a model in place that does make explicit the reinsurance component, separates out the social policy function that some have criticized in the previous section with a market access fund, and you know, we think we've got a better proposition going forward. I just don't think the notion of the status quo, echoing what Senator Tester said, Bob, you may want to weigh in on this as well. I just don't think that is a viable approach.
Thank you.
Yeah,
Anybody else
thanks.
want to say anything? Want to say
Well,
anything?
I do want to comment about the House of Representatives, and it's a frustration, I think, to a
Can you
lot of
speak to the
folks when,
microphone, Susan? I'm sorry.
I just want to comment about the House of Representatives. It's a frustration, but not doing anything means that we're going to continue to have the risk borne by the taxpayers. We're going to continue to not have systemic reform, and we're not going to give certainty to the financial markets. And that is a huge part of this, making a decision. We think that we've come up with a great plan for discussion. I'm sure there'll be other plans that will be discussed, but it is not acceptable anymore in the United States Congress to delay making decisions based on ideology or based on a point of view that no longer moves the country forward. And that's a critical part of the effort that we've embarked on and engaged on here, and that signal needs to be sent loud and clear. It's time for reform. Let's have the discussion, but let's at least consider all plans. No one should be so much in love with their idea that we aren't going to listen to another idea. But this has been the product of some enormously talented folks, including 2 senators behind me, thinking about where we should head. So just want to make that point about the House.
What kind of was as tough as
We
it?
rest our case.
We rest our case. We're done. On that note,